that was impressive. And I am alone.
Oh,
I am no longer alone.
there we are.
All right. Christian Babcock, welcome to Real Estate Unscripted. For those who don't know you, and they should, best damn loan officer this side of the Hudson, right? Tell me a little bit about yourself. Loan officer, producing manager at Loan Depot. Office still in Tarrytown on White Plains Road, or is it in White Plains on Tarrytown Road?
It's close. We are White Plains on 1 North Broadway, corner of Broadway and Main.
Gotcha.
Mm-hmm.
And but that is not where we go. I mean, I've literally never been to that office. I think I was on the one in Tarrytown years ago.
We moved right in the middle of COVID. We moved in April. We signed the lease in January 2020. Moved in April of 2020, and it's been tough going since then.
It's been a ride. And how many times have you actually been at that physical office?
I go in on occasion from every couple weeks or so.
Yeah, same here.
Yeah.
All right, so for those, I did a quick bio, but you are a loan officer. You are producing branch manager. You have overseen countless millions of dollars of purchase money financed for our clients.
Mm-hmm.
People like you. Always a good thing. Tell me, for those out in Facebook land and broadcast land, a little bit about yourself. And we are fellow English majors, as I recall, right?
We are.
Two liberal arts guys
That's
in the high fancy world of housing and finance and the ivory tower.
I studied to be a secondary education in secondary ed. I stopped at the student teaching portion. I took all the education courses, all the English courses. So I do have an English degree and secondary education. But I've not seen a classroom. But so it's been a long time. But I write great emails.
You do. You use your major every day.
Right, with very little grammatical errors. And I like to think I'm well read.
That the cultural references, that sort of thing, you cannot put a value on.
And at one point, I was able to recite the introduction to the Canterbury Tales in Middle English from, which was part of my final exam for my Chaucer class.
Okay, so that reminds me, you've heard of Jim Croce, Time in a Bottle, that guy?
Mm-hmm.
Okay, so one of my very, very favorite musicians died tragically when I was 6, and you were probably weren't even born yet. 1973. Were you born in 1973?
74.
74. Okay, so you came after. For all we know, you could be the reincarnation of Jim Croce. But Jim Croce graduated from my alma mater, Villanova, also another liberal arts major.
Mm-hmm.
And he said unequivocally that he graduated college fully prepared for life in the Middle Ages.
That's right.
That's one of the great lines that I heard him say.
I'm there also. I would be able to communicate.
Right. So we both could know our way around Beowulf and all that. And then we get out in the world and we got to pay the rent.
Mm-hmm. Mm-hmm.
And so that led you, were you a loan officer right out of college, or did you do something else?
No, I did a lot of things. I was one of those people that never really knew what I wanted to do. I kind of envy the people that, I actually know a woman that I went to grammar school with, that from the very first time we were asked, what do you want to be when you grow up? She said, I want to be a lawyer. And she is a lawyer. She works at the Bronx DA's office right now and is married to another lawyer. And I always look back at that and I'm like, wow, she always wanted to be a lawyer.
She had to figure it out.
Yeah. And I never knew, so I tried a lot of different things. I worked in, my parents owned an HVAC company for many years that they recently retired from, but I did that out of college. I worked also a lot of blue collar stuff. I installed home theater systems in very rich people's homes, things like that. And then I got into sales. But I actually partially used my education degree. I started selling computer training at a company that was a global computer training company. They're still around. But it was a franchise office, and we would sell both Microsoft Office training, all the kind of back end IT stuff, for help desks and everything. This is the, like late 90s going into the 2000s, when companies had very large staff in their IT departments. So we would train their end users and also their IT people. So we would sell, that training. So that's where I started teaching the courses, because I liked computers and I had the teaching background. And then I got into the sales side. I eventually started managing the sales force there. I managed about 10 or 15 salespeople there. So that's where I got the sales training, sales background. And then from there, I had a friend that started doing mortgages at Bank of New York Mortgage, BNY Mortgage. Bank of New York was
and that is the part of your story that I always remembered. You started out in mortgages at Bank of New York, right?
Right. Yeah. So that was 2002, May of 2002. So I just celebrated my 20th year in the industry this past May.
Happy anniversary.
I did.
Happy anniversary. So two things. Like, everybody, in my opinion, before they start in their fancy career jobs, would benefit from doing two lines of work in the beginning: manual labor of some sort and working for gratuities or tips, because both of those lines of work ground you in a way and give you empathy and give you insight into what people are going through. And I remember, working at Southside Deli, by Sing Sing Prison in the 80s, where there was a phone bank out in the parking lot, which was used for, nefarious purposes at times.
Right.
And when the prison guards weren't coming in after their shift, there would be guys coming in various stages of physical distress, because maybe, a deal didn't go down well or something like that. And that was me, little peach, tinted me, who looked like, he was 12 when I was 19 years old. But it gives you an insight into how the world works. It grounds you in ways.
I always look back at that time, especially working, for doing it was commercial HVAC. All of our business was in the city. It was, and I'd be on roofs. I'd be in hot boiler rooms. And of course, my father would always send me and my brothers on the worst jobs, crawling in crawl spaces with cockroaches, and, to run a wire from here to there, or, be on a roof to change, in 100-degree heat on a hot roof. I always look back at that. No matter how hard I could possibly work, I'm sitting in air conditioning in front of a computer on a phone most of the time, not on a roof or in a boiler room. So I 100% agree.
And isn't there sort of like a unique discomfort of having fiberglass insulation down your back?
That was a joke that they played on us when we were doing that for the first time. They said, make sure you wash with warm water when you're done, which is the complete opposite of what you're supposed to do. When you wash with warm water, your pores open up and the fiberglass gets into your pores. So that was a joke that they I remember.
Nice. Such kind, loving people in your life, right? All right. So Bank of New York, you were there for a while.
5 years.
5 years.
To Chase. Yeah.
Right. So it was about 2006, 2007 that they became a Chase property?
Right. Well, at that time, they sold only the retail branches to Chase. They didn't sell the mortgage company. They sold the mortgage company was sold to Everbank at that time.
Right.
So for a short period, the group of us worked for Everbank, also out of Westchester. And then we all actually, as a group, looked at where our next move was going to be, and chose to go to Chase as a group of loan officers. There was about 10 of us at that time.
Quite a group for Chase to take on, huh?
Oh yeah. That was and during an interesting time. It was, right. Like, at that point, for your 2007, we were just getting into the tip of the iceberg. In fact,
things are starting to happen. Yeah.
Right, we all got recruited like that summer, and Lehman Brothers was like that October. So it was, it was a very interesting time and a good place to be at that time.
So how did you weather that storm? So, 2007, the subprime domino falls. And by 2008, the entire financial infrastructure of this economy is teetering on going back to a barter economy, right? And if the government didn't write what was it at the time, $1 trillion check, we don't know, big cratering crash of the economy. How did you weather that craziness? Because they weren't loaning money much back then.
It was very interesting because when we started there, it was, even Chase, as conservative as they were, had a subprime division. They had, at that time, if you put in the right information into Fannie Mae's underwriting system, you'd get loans, you'd get findings that came back with no documentation needed. So, if you put in, if it was 20% down with a 700 credit score, you can put in the income, put in the assets, and it would be get an appraisal and a contract, and you can close. We were, and also,
I would think with a 700 FICO score and 20% down, that is probably more responsible than the other stuff that was going on at the time.
It wasn't totally unsafe. But then we were also piggybacking HELOCs on top of them, just to have. Just to have. But it changed almost overnight. It went from that to the rates on jumbo mortgages at that point was skyrocketed because they just shut them down. So then there were really many jumbo investors at all. So that's when Fannie Mae decided to Fannie and Freddie had to raise their high cost limits to service some of the higher loan amounts in specific counties, which they still do now.
Yeah.
And the PMI companies were going under just as fast as mortgage companies were going under.
I remember that.
Right.
I remember having a short sale approved.
Mm-hmm.
Everything was set up, but the PMI company shut it down. And I'm like, How does that even exist? How can that even happen?
So the problem is with PMI companies, they're private companies. So the ones that survived just got so conservative with their guidelines in terms of their credit score requirements, their debt ratio requirements, that, if you can get somebody the loan, but we couldn't get them the PMI. So then, we would have to flip them to, this is where FHA made a huge comeback. Prior to 2008 or 9, I never wrote an FHA loan, for 5 years. They were always on the rate sheet at Bank of New York. Like, the first page was always FHA. And I was like, oh, what's that? We never had to do them because we had so many other better products.
Yeah.
And that's when FHA really took off.
I have a theory about how the management of FHA contributed, or the mismanagement of FHA contributed to the subprime monster being created. Mm-hmm. Because I think in 2004, when W was reelected, I think the FHA loan limit was some absurdly small number, like 250,000 or 350,000.
Yeah, it was low.
Mm-hmm. And in a county where the median price was at the time 600 or something like that, mm-hmm. no one would do an FHA mortgage. So if you had less than perfect credit or not a lot of money to put down, there was no product for you. Mm-hmm. And that vacuum created the mm-hmm. subprime monster, at least in markets like ours, right? Mm-hmm. So it had the good things of FHA, forgivable credit, mm-hmm. lower down payment, but it didn't have the things that FHA had in its safeguards, which was full documentation, mortgage insurance, everything like that.
Right.
So when FHA was neglected, in my opinion, the subprime monster was started. When FHA was updated and re-energized with higher loan limits and, more government gusto, that's when we first started to see people were actually able to borrow money again. And I remember selling a house in Dutchess County, and they just listed it with us and sold it again. But they had good, 15 years there. We're talking about like an IBM executive buying what at the time a $700,000 house, FHA.
Yeah.
It's the only way you could get the mortgage.
Yeah.
It's the only way you could do it.
Yeah. Yeah. No, 100%.
So FHA was the
they very least left the door open for the
Yeah.
subprime crisis to happen, because it was also just a completely unregulated market on top of it. So
Yeah.
to your point, right? The door was open. There was no regulation. There were so different products were coming out like crazy. I mean, I remember we started, Fannie Mae had a no ratio product that required a 720 minimum credit score and a 20% minimum down payment. So by no ratio, you just didn't put income on the application. But it was the same point. It was if somebody with that high credit with 20% skin in the game, we're making the assumption they're going to pay the loan. So it made sense. But from that time, which was probably 2004 or 5 when those products were coming out, they were just getting crazier and crazier and crazier and crazier. 100%, 106% financing with a 500 credit score. No income, no asset documentation. I mean, everyone's heard the ninja loan. I mean, we never had access to those because at that time I was in banks, but I knew brokers at the time that, I mean, literally can get a mortgage for anyone that could fog a mirror. It was crazy.
I used to originate earlier part of the decade, and that decade, 2000s, not the teens, but I remember salespeople from the wholesale departments of subprime banks coming in, and they would give their pitches to the loan officers about, and literally, if they can fog a mirror, we will loan them money. And of course, there's no shock to me that the whole thing was a house of cards and it all fell and really harmed millions and millions of people. So when I, at some point, you left Chase and you went to Mortgage Master, which is when I met you. What precipitated the decision to go from fancy JP Morgan Chase to Mortgage Master, which not a household word at the time?
Not even close. It was really a small lender out of Massachusetts, and the owner wanted to expand down the East Coast. So we were the first branch outside of Massachusetts for the company. And at that time, he found our branch manager, my direct manager, who got us, interviewed, and we sat, and had to sit down with him. And at that point, it kind of relates back to your first question, which was how did you weather the storm during that time? It was extremely difficult, So 2008 going into 2009, I was very close to quitting the business entirely. Because it was just, I used to walk around saying if I put this amount of time working in Starbucks, I'd be making more money. So I was putting in the hours, and just the income wasn't, the output wasn't there. It was like trying to find the perfect fit. So that, the buyer pool was so limited, and we just weren't writing a lot of loans. So, they came in at that time, which was also pre-Dodd-Frank, and said, we're the complete opposite of what you're used to. We're still very responsible lender where everything is, the same, but we're just doing loans differently. Our operations, it was a very small boutique type of place. So you had immediate access to everything we needed, which at that time was just product, price, and operations.
Right.
So I said, you know what? I didn't have any kids. I was living in a co-op. My wife and I were recently married. I didn't have anything to lose. I said, I'll give it a shot for a year. And if I still hate it, I'll do so. I'll do something else. That was the decision. And after that year, my business doubled. It was mostly FHA still, but much easier to do FHA loans there. My income was there, and I fell back in love with the business. And then it was really just kept going from there.
And it's been a ride. So now we are in 2022. We've witnessed, a fairly long sustained recovery over the 2011, 12 on and on. And we went into 2020, I think, by and large, with fairly high expectations about the continuation of a stable, improving market. And then the black swan event, COVID, happens. And there were about 90 days, I want to say, at least in the brokerage side, where we were not considered essential. And I didn't know whether that would be an extinction event for us. But thankfully, after 90 days, Cuomo woke up, came to his senses. We became essential again, because imagine this, people want to live in shelter.
Yeah. Or move.
Thanks, thanks, Andy. And we saw the most cartoonish, bananas, unprecedented, which I hate that word, but nothing like it. I have never seen anything like the stone buyers had to push uphill just to get their offers accepted. And I will tell you that I can think of a deal or two over that time where we would see a Loan Depot or a Christian Babcock pre-approval, and that made a difference because we could go to the seller and say, I know this guy, this is gonna fly. How did all that appear to from where you sat? I mean, you saw the same cartoonish craziness as well, right? I mean, did people come to you and say, if I waive my mortgage contingency, am I going to regret it? I mean, I imagine you got questions like that, right?
Oh yeah, well, still do. I mean, it's still there. I mean, but it got crazy really, really fast. Especially it was like the gate was being held and then was just kind of released. So you had all this pent up demand. You had people that were looking to migrate and move from wherever they were, and in my view, it made the pre-approval once again, which is also a result of the last recession where, like agents prior to that would take anyone out because they knew they can get a mortgage pretty much anywhere. If my one guy can't do it, somebody else could.
Right.
So, in my view, it made what I do a profession again, to, having to know what you're doing. And it made the pre-approval that much more important again, because if it's done wrong, the person that's looking for that house is not going to end up getting it. So one of the results were, because of all the protocols and the extra disclosures that you need to have signed just to get somebody into a house, the pre-approval became one of those things. Like, we can't even get you into the house without one. So now you got to get one and make sure you're getting it from somebody that knows what they're doing. So, and I've always looked at the pre-approval, and I can't imagine why some people don't share the opinion, but most do. It's the most important part of the process. I tell people, like, you're not going to go, if you want to spend $500 on a car payment, which most people have an idea of how much they want to make on a car payment, you're not going to go to a Bentley dealership. So why would you want $1 million pre-approval if you have a $400,000 budget? And so that's really the way that I do it, as opposed to just throwing out a big number and say, hey, here's $1 million, go find a house, and then find out later how much it's going to cost. I actually will drill it down closer to what they want to spend and get them in the right price point. But that, again, it made the pre-approval very important.
Just because you can afford it doesn't mean you need to spend it, by the way.
Exactly. Right? Exactly. And people after especially younger people, I find, are much more conservative on their housing payment, because they want to do other things. They still want to go out to dinner on the weekends. They want to hang out with their friends. They want to travel. So they're not looking at just getting into a house and being a slave to that payment or those expenses. So they try to be more conservative if they can.
Yeah. Yeah. Well, I think one of the things of the mark, I think, of a good loan officer is going to be them not trying to squeeze every possible dollar out of that loan. Right.
Right.
So if you have somebody in front of you who could be $1 million loan, but you encourage them to not max out, that's integrity. They should trust you going forward from that, because then it's pretty clear that this is not just about maximizing their income, but fostering a good relationship and a referral driven relationship, which I know you have. You get a lot of referrals.
Yeah, absolutely. And it also comes with life experience also. I'm a father. I have 5 kids, as you know.
Yes.
I own a house now, and I've owned it, the house now since 2011. So I know what the expenses of owning a house are in Westchester.
Yes.
I mean, it's not just the mortgage and property taxes. And, my property taxes have gone up substantially since 2011. Every reason that they find to raise them, they do.
They
You
do.
know, so, and I come even from that perspective, especially when you have a first time home buyer, to say, there are other things you have to pay for. I mean, you might want to be, if you're mowing your own grass, if you're doing all, I mean, there's maintenance, so, I get into those conversations, when I'm trying to help somebody establish the right budget.
Yeah. So what is your kind of favorite type of borrower? I mean, do you like an investor? Do you like the first time home buyer? Do you like somebody who's buying that dream home? Is there a favorite category you have there that is your bag, or does it just depend on the profile of the applicant?
Well, I like them all, I mean, whether it's a refi, an investor, a second home, I have, I like the fact that I have a lot of people that did loans 4 years ago that are coming back to now buy their house or buy a second home or something like that. But, I definitely still have favoritism towards first time home buyers, new families that are starting out. It's their first home, because, there's a feeling of, gratification, helping somebody with that first step,
Yeah.
So, because, you can relate back to, my first step, buying our first house and then having, and growing into it as we have.
Yeah.
Yeah.
Yeah. I would say, by the way, that you and I are doing our share respectively for the Social Security system with, your 5 and my 4. I think we're doing our share.
That's right.
For, population growth, Social Security, all of those things. Now, what's the age range? Your oldest is 10?
So we'll be 10 in September.
All right. So you've got 5.
Mm-hmm.
How many are in diapers right now as we speak?
Just one.
Just one.
Yeah.
But you've had someone in diapers for a solid decade, probably. Probably has not been a month goes by where there isn't like a diaper being changed.
That's 100% accurate. We set up a diaper, changing station 10 years ago, and it has not left.
it is there.
It's the part of the house now.
The floor is worn out beneath it.
The house would look strange without that setup.
And we have dogs there, cats, pets,
one cat now. We had 2.
Cat.
One died, one cat. Yeah.
Gotcha.
Yeah.
I don't have you beating the kids, but we got you beating the chickens. We got 5 chickens.
Yeah. Considering kids at some point.
Don't get roosters. They're not allowed. But no. Okay, so here we are. It's 2022. It's still a crazy market. All right. I would say that we're probably in Tim has how many kids? 6. I think Tim has 6. Oh. Tim's got us both beat.
Wow. Nice.
Yeah. There's that we're a fertile crew here. Yeah. Do you need to get that or do?
No.
Okay. All right. So here we are. It's 2022. It's still crazy market. I wouldn't say we're post-COVID. I would say we are now in the age of just pandemics. Mm-hmm. I still wear a mask when I go to the eye doctor or I go to any health-related kind of a place. Mm-hmm. We are still getting warnings about monkeypox now is the thing now with COVID no longer being the urgent threat to life that it was. And we are still, but we're entering sort of a new era with higher rates. And I say higher rates with a smirk because in historical perspective, even though rates have, doubled maybe over the past year and a half, 2 years, they're still pretty low, at least in my opinion.
No.
Like I remember when rates were 15 and 20% and listening to my dad, who was an accountant, tell my mother, it's not about the rate. Can you afford the payment or not? If you can afford the payment, you're fine.
Right.
Have you seen, I guess refis have dropped off the face of the earth.
Refi. Well, there's a couple, some people need to refinance at certain stages also. I mean, you have divorce, but people that are looking to maybe take equity out of the house that don't necessarily want to do it on a line of credit or, something like that. So there's a couple around, but for the most part, they're gone, for the time being.
Right.
But they'll be back. I mean, we have, one of our mortgage kind of gurus, national coach, has a saying, where when you're buying a house, you marry the house, you date the rate. So, which basically means, people are looking at a higher rate environment right now. I mean, right now we're in an odd time because we're in a high price environment and a higher rate environment, so
Yeah.
people are definitely paying a lot more from just a year ago. But, interest rates will go down, whether or not they go ever into the twos again, probably not. But, low fours, high threes, which is pretty much where they were prior to COVID, is definitely in the foreseeable future. And, you could save a good amount of money on a refinance down the road.
If that,
So, mhm,
when that does occur, I think refinances will make another comeback. And
mhm,
we saw high rates, high sales, high prices in the early and mid 80s too. Rates were crazy,
mhm,
but prices kept going up because, look, people don't buy houses solely because it's an investment. And
mhm,
I'm sure you tell people this also.
mhm,
People buy houses, it behaves like an investment,
mhm.
but you buy houses so that you don't get wet and cold,
Right,
right?
right,
You buy houses so you can have shelter.
right, right,
And the people that try and time their home purchase with either low rates or, the prices bottoming out or something like that, I
right,
think are kind of missing the point. You
right,
buy a house to fit your lifestyle and your quality of life. You don't buy a house because, you know, this index hit here,
mhm,
right?
mhm.
I don't know what the rates were when you bought your house in, was it 2011?
2000, yeah, they were low.
Five or
They
six,
were,
maybe.
yeah, they were
Yeah.
they were low. But
Um,
I have the same conversations. I ask people, and it goes back to your question, like which type of buyers do I favor? You know, I'll ask that question when people start getting to that conversation is like, are you looking at this as an investment, a stepping stone or something that you want to try to sell in a short amount of time to make money on and move on? Or are you looking to stay there, grow roots, start a family, use the schools for the next 18 years? I mean, because, if the latter is the case, you're not going to lose, not in this area, you know?
100%,
Yeah.
100%. Do you
So,
see uh, a bubble or a collapse anytime soon? I don't, and I've had a lot of conversations about that. But do you see a correction of some sort, or any bubble, or any big decline coming?
for the most part, I agree with what that I don't see a crash. A correction certainly. In certain segments of the country are going to see a bigger correction than others. My main focus has never really been on national news. It's always on very local.
Right.
And even in the recession, I mean, then the worst recession we'll probably ever see in our lifetime. I mean, yeah, there were certain segments
Oh,
locally that lost 40, 50%, but there were others that only lost 10,
yeah.
to maybe 20 at the worst. So we're not going to see that because right now the economy and housing is not being propped up by bad mortgages. Every mortgage we've been doing for the last 12 years, since the recession, have been fully documented, pay stubs, W-2s, tax returns, proving, and it's a law to prove that a person's primary residence, they can make that payment. And as I said earlier, I still have people that are even much more conservative and want to spend a lot less than what they can actually afford.
Yeah.
So, I don't see that for that reason. What'll cause a correction is supply and demand, which is what a high rate environment will do. It'll suppress some of the demand and allow the inventory to catch up. But when it does catch up, when you look at the local absorption rates in the towns and cities in this area, I mean, until there's an oversupply of inventory, is when you're going to see prices go down. And when is that happening?
That
You
not
know?
going to happen anytime soon.
Right.
It's funny, the low inventory that we're in is being helped a bit. In other words, inventory is starting to increase because houses are spending more time on the market, but
Mhm,
we are nowhere near
mhm,
a decline the way some of the clickbait articles would indicate. And as a matter of fact, I would actually say that with the cooling market, it's actually more fun to sell to a buyer than it was 6 months ago.
mhm,
Because
mhm.
6 months ago, it was trench warfare.
Oh, it's horrible.
You'd look at 12 houses, if you were lucky, 8 houses, 6 houses. You'd make a bid on 4 of them. All of them would be denied because somebody outbid you with some crazy, cartoonish, exaggerated,
Mhm,
uh, you know, cash as is, no mortgage, blah blah blah. All this crazy stuff, but there's just not a lot of inventory left. And I don't know if some of that is because of the pandemic or because it feeds on itself. Home sellers who might otherwise sell don't know where they're going to go. I've seen a lot of that. We don't know where we're going to go is a big problem. But I think as inventory grows, things will ease up and it'll be a lot easier to represent buyers, because you can look at a few houses more than you looked at before. They're not all going to disappear the second. You're not going to have the stress of, oh my God, if I don't act now, I'm going to lose it.
Right.
And you make an offer, you make a fair offer. And you know what? If it's a good offer, you probably get accepted and everything will be fine. It's not this exaggerated, exuberant craziness where you had a 1 in 10 chance of getting it, even if you sold your soul.
Right.
So yeah, I don't see that either. And you said the money words that you just said that I would highlight in yellow is there's not a lot of bad mortgages out there. And when we saw the crash in the late 80s, which was due to savings and loan malfeasance or whatever you want to say, misconduct, bad loans, and subprime, again, lots of bad loans. There just aren't a lot of bad loans out there. And because there aren't a lot of bad loans, there's not a lot of shadow inventory. There's not a lot of distressed inventory. So without distressed inventory, what's going to be there to keep it honest? It's starting to come back. We see in our REO department that some foreclosures are starting to come back, but not nearly at the rate that we saw them before. So you see things kind of getting boring then, which we love, right? You see things kind of
normal,
normal. Okay.
So, and even the pent up, sellers and buyers, the people that have to sell, whether it be a co-op, a condo, or a smaller house in order to buy, have been pushed out of the market for that reason, because, I have to sell my house or my co-op to, because there's equity in there that I need, but also I can't afford to carry two properties at the same time. Those people have been completely pushed out of the market in some cases. But you're starting to see those, because sellers don't have 20 offers necessarily in 24 hours in some areas where they might be willing to say, okay, well, we can wait, for this person to sell their place, but there's a whole other segment of people that are potential buyers, So that's why I would say too, as far as like the inventory and the demand and the supply and demand equalizing, once there's even an opportunity for that, there's still so much pent up demand of people that just haven't been able to buy in the last 2 years that are still waiting in the wings that still want to buy.
Yeah. I think the underpinnings that you're pointing to are very, very strong. So here's something I think anybody would ask of a loan officer, and I would be remiss if I didn't ask you, but give me one thing that, maybe this time and time again mistake that prospective borrowers make. Like what makes you open the liquor cabinet early that a borrower will do all too often? Is it, they get pre-approved and then they go buy a car? I mean, where do borrowers trip these days?
There's not a ton that you can't correct if, especially when you're not pushing them to the last decimal point that they qualify for, so, but, those things, a car payment will pop up, where, if we pre-approved them as long as a year ago, they needed a car and they got a new car. There's enough information out there though now, luckily, that I'll actually have people ask me before they make a move, which is good. But most recently, job changes always cause a certain heart attack. Well, right. I literally just had one in the last 24 hours, where we had a loan that was clear to close and the borrower neglected to tell us that he was leaving the FDNY and going to another job, right? Like we're scheduling it, but again, that was fixed because, when you're going to a new salary position, we can just update the new employment, we get a pay stub and we move it on. So it's not impossible, but there are certain, types of employment or the way people can be paid, whether they're going from a W-2 job to becoming self-employed, which has happened, that can make a loan.
Oh yeah. Self-employment is take it from me. Believe me.
Right.
All right. So I need you to help me dispel a myth. We have people who are concerned that if they get pre-approved, it's going to ding their credit and damage their credit because, they got pre-approved 6 months ago.
And I was hoping you were going to ask me this one.
All right. So I did not disappoint. So, I mean, look, sometimes people have to get their pre-approval updated, or, they checked Credit Karma, whatever it is. Could you please dispel this baloney myth that the mere inquiry of getting a pre-approval is going to wreck your credit?
Right. I'd love to, because this is one that I get every day,
Okay.
constantly. And I have some friends that do credit repair, and they have credit repair companies, and I've gotten it from them, in terms of what inquiries mean, what the biggest weight of your credit score is, and things like that. And I always tell people, if you are trying to find out if you can get a mortgage, why would it hurt your credit score for us to look at it? There are the soft pulls, the hard pulls, yes. We look at credit scores in a range of 20 points each, so we look at, 620 to 640, 640, 660, so on and so forth, up to 850. It's usually the people that have the 850 credit scores that don't want to pull, because they're obviously doing, very concerned and aware of their credit, which is great. But, a hard pull, quote unquote, takes maybe 1 point off of a score that ranges from 450 to 850. So it doesn't impact your credit in a negative way. On every credit report, though, that you pull, it actually shows you how the algorithm is scoring you, and credit inquiries is one of those things.
Right.
Now, if you go to a mall, if you go to, the Westchester Mall, and you go from, each store, and you take the 5% discount to open up a credit card, those inquiries will hurt your credit. When you're taking a new line of credit, a new credit card, and a new line of credit hits your credit report, that you do take a significant hit when a new credit line is open. But when we're looking at it just to see if you can get a mortgage, we're not offering credit to you. We're not opening a new line of credit. We're just looking at it to make sure you can get a mortgage. So it doesn't impact it in any way that would be even close to significant at all.
Okay. So I had some fun with my credit person years ago when I had a radio show, and we talked about the hard pull and the soft pull. And Eric, if you're out there, this is for you. The difference between a hard pull and a soft pull is the hard pull is what you just described. We walk into a jewelry store, you apply for the jewelry store credit card. That is a hard pull. That's a bona fide solicitation for more credit. A soft pull is I might get on Credit Karma and check my own credit, right? Is a mortgage pre-approval a hard pull or a soft pull, or is it somewhere in the middle? Is there in the middle?
I want to say it's somewhere in the middle. It's still technically a hard pull, but it doesn't drop your score 20 to 40 points like some of the others would do,
Right.
So, but it's still classified as a hard pull.
Right.
Yeah. Really, because we're pulling all three credit bureaus and we're going back to a 10-year credit history. The softer pulls, and which is causing a lot of other problems in terms of confusion about credit scoring, places like Credit Karma, Discover, every bank now will show you a credit score. They're doing these they're looking at a 2 to 3 year history as opposed to a 7 to 10 year history. So those scores typically come in higher because they're not pulling as much data into the algorithm to score you on. So if you haven't had a late payment in the last 3 years, Credit Karma could be showing you a 750 credit score. But if I pull one and I see late payments even as far back as 2018, 2019, our score is going to be significantly lower. So, because those old payments, even one, can really hold your score down 40 to 60 points for a long period of time, unless you know how to kind of trick it out and, boost your credit score.
Okay. Well, I'll tell you what, in this context, I'm with you. The most important thing a person can do before they buy a house, if they're not paying cash, is get pre-approved, period. Because you know what you can afford. And now you are a viable buyer. You can now prove that you are a viable buyer. And that is important. And of course, the equal housing ramifications of encouraging people to be pre-approved before you show them property are crossed to bear. But I think credit overall is one of the most misunderstood. It's like sex. money and sex, right? It is one of the most misunderstood emotional things that people have. And this has probably happened to you. It's happened to me. Someone will say to me, oh, my credit's terrible. And then why? Well, I got divorced in 2015 and, I was late on payments on a car in 2017.
Right.
And then you got a guy who, I wouldn't loan him a book. He thinks he's got good credit, but
Right.
like it's undulating. It fluctuates like your weight.
Right. Right. No, and it can fluctuate significantly even with one credit card balance. If you historically use a credit card, at 10 or 20% of the credit limits, and then let's say you book a vacation and you put it all on the credit card when you first booked the vacation, and now you're utilizing 60, 70, 80% of that one card, you can drop 60 points. 60% of the credit score is credit card utilization. That's 60% of the score. So utilization meaning the balances you're carrying and late payments. So if you have somebody that has a combination of high balances and late payments, you could be 100 points less than somebody that has, never had a late payment and keeping a low balance. It's a significant difference.
And the good news, though, is that if you pay down your credit card balances, you can dramatically improve your credit without having to go out and do something, crazy. Yeah. I mean, I took it on the chin after my divorce. Secured credit cards were a great tool for me. Absolutely great tool.
Yeah. But on a mortgage application, I always say, pretty much everything except your income can be fixed. We can fix credit. If you don't have money for a down payment or closing costs, people have a way of finding gift money or even money in a retirement account, or at the very least in a short amount of time, once they know how much money they need, there's a path to get there. But income, there's plenty of articles online that show you like the top reason that mortgage applications are denied is for debt to income ratio. Because income is the most important part of the application. And when that's done wrong, that's when the loan collapses later, So, but back to the point, even of the pre-approval, one of the reason that I partner with a lot of agents is not only am I giving them a pre-approval that they know is going to close, but I'm also giving them very specific parameters to find, after I have this conversation with the borrower and they know how much they want to spend, I send them back to the agent to say like, okay, they want to spend, no more than this. Property taxes, with a realistic range of where they're looking, no more than that. This is their down payment. So now that agent might be able to show them 5 houses instead of 50 because, when they're showing them the other 40 and they don't have any idea what it's going to cost. And then they come back later and say, oh, well, that's too expensive. Let's adjust our price point. There's no readjustment really needed unless maybe they can't find something and they're being too conservative. Maybe you'll have to increase it as opposed to decrease it.
Yeah.
But I recently had an agent that had a whole weekend scheduled with a buyer in a 650 price range. And that was already pre-approved with a 650 letter. And after I spoke with him, and even though he still could get a $650,000 house, when we did the math on how much it was going to cost, he readjusted his price down to between 450 and 500. So that agent then canceled every appointment for that weekend, and thanked me because he would have wasted an entire weekend only to find out later that the guy was going to get cold feet and pull out.
Okay. So there's another question I know you're going to be glad I asked. Why is it important for a prospective purchaser, to use a local lender like Loan Depot, like you, as opposed to just getting online and getting that fancy rate from that online bank? What's the difference?
Well, the same reason that I won't do a loan in Texas, or I won't do one in California or New Mexico, because I don't really know anything about those areas. Even though the functional, I can get through a loan application in those states. New York specifically is completely different in terms of how we transact. Attorneys, timing, closing timing. Which also then relates back to interest rates and whether or not we're going to lock one in or let it float. But property taxes being the main one is the main mess up I see from these online banks, because the property taxes in this area, as we all know and love, are the highest in the country. Yep. And they're very different, whether you're, in the city, Bronx or the boroughs versus Long Island versus Yonkers versus Dutchess Putnam counties, So, without knowing the kind of the local average property tax amount, you can't really get the math right without really having an idea of what the taxes are, because it's the biggest part of the payment in some cases. If I move somebody's loan amount for $50,000, that's going to have less impact than if the taxes are, from 8,000 to 15,000 per year. That's going to have a bigger impact on their mortgage payment and their qualifying payment than the loan amount or even the interest rate. So
for me, it's about accountability.
That too. Mm-hmm. Mm-hmm.
Right. So it is important for me that I can pick up the phone and talk to the loan officer if something comes up. Mm-hmm. And when people say to me, well, what could possibly go wrong? I'm working with Quicken or working with, loans.com or whatever the hell they're doing. What they commoditize professional advice, right? All loan officers are the same. All real estate agents are the same. It all goes on MLS. Who cares? That's what drives me crazy. They commoditize professional counsel, and they don't understand individual accountability. And we had a conversation with somebody who, talked to one of the grunts at the national lender, the internet lender. And I forget what the story was, but they were getting a new mortgage. They were selling a house. They were going to make a big principal payment on the new mortgage. They were forced to close before they could put a bigger down payment on, and their loan had to be recast. And they could never talk to the same person.
Right.
Recasting, we should probably explain, but which you could do a better job than I could. But that accountability was missing, and the person was absolutely at the end of their rope because they could never talk to someone who could make a decision or help them.
Right. And if the loan officer finds out that they made a huge mistake, they, sometimes can be hiding under their desk and stop returning phone calls, which is not great, but happens.
Yeah.
But yeah, I mean, but the local part of it, for example, right before this call, I pre-approved somebody that has a co-op in the city that wants to buy a house in Dutchess and Putnam County. And first question I asked them was, how much is the monthly maintenance? Because if you want to carry that co-op at the same time and not have to sell it, we're going to have to qualify you with the mortgage and the maintenance. That one is the most commonly missed by outside New York lenders because they don't even know what co-ops are.
No idea.
Never mind to ask what the maintenance is. So usually that person could have applied for a mortgage, gotten even a commitment letter, and then the underwriter would be the one to say, oh, this is a co-op, it's probably a maintenance payment. Let's find out what that is. It's $900 more a month. Yeah. That could blow a loan right there. If you don't have that information in the beginning. So there's so much, local and again, working with somebody that works on referral is a big help too, because I hold myself accountable, and my agents and everybody hold me accountable, and loan officers like the ones we have here locally are all on, referral, so it's all, and those referrals are from agents, past customers, people that we did a good job on. I don't have the luxury of messing up a deal and then my phone rings 5 minutes later with a new customer and with a fresh start. If I mess up a loan, I can blow an entire relationship, so.
No, we are being local. We have to take care of everyone very, very well. And look, you've got a double whammy here because you don't just have the borrower to deal with, but especially with your model, you've got the agent. And the agent has to be satisfied that the next referral they give to you will be taken care of, and you will have accountability, and everybody can look each other in the eye, and that is no small thing. That is no small thing for sure.
100%.
So the old joke I have, one of them is that this country was built by guns, Jesus, and credit. And of course, you don't factor much into the guns and Jesus, but I'm glad we had something to say about the myths around credit. It is irresponsible to talk to any loan officer and not bring up the idea of the importance of working with a local lender and having local expertise. Is there any other mistake that people make that we can dispel in the minute or two we have, or 3 or 4 we have left here?
The job change is definitely one. And, that buying something in the middle of the transaction, never a good idea.
Mm.
And I've had people ask me before they close, hey, there's a sale, Memorial Day sale on appliances. Can I go buy appliances? And I always say, you don't have the house yet. So buy appliances. I know it's so tempting to save that money, but there'll be a 4th of July sale.
Yeah.
There'll be a Labor Day sale. There'll be, get the house, get the keys, buy the appliances.
Yeah, I'm with you there.
Yeah.
Appliances and things like that are sometimes the bane of our existence. Did Tim just ask a question? Rate hikes. You see rates actually coming down, right?
Rates came down last week by as much as about 0.5%, after the Fed raised their key interest rate. That's another very common one that we get by, by everyone. Everyone, I heard, they're raising rates. That means mortgage rates are going up, where, there's no direct correlation between the Fed funds rate and mortgage rates. Where what mortgage rates look at are signs of inflation. So, if we're lending money for 30 years, we want to see what that money is going to be worth 30 years from now. And that's how rates are determined. They're also determined by mortgage-backed securities. That's a whole nother part of the conversation. But the easy way, is what they said at the last meeting was that the Federal Reserve and the administration is committed to fighting inflation and getting it back down to a 2% range. Right now we're in the 8 to 9% range. And so by them raising rates, it's essentially making it more expensive to borrow on other things: credit cards, cars, consumer type credit, home equity loans, home equity lines of credit. Are all directly affected by that hike, which then, will hopefully cause people to spend less money, which then will bring prices of goods, to come down, which is how they're combating inflation. So it's a very, very interesting approach, because they're hoping for this soft landing, of, okay, we're going to get it down, and then maybe we'll reduce rates and hopefully can get it back down to normal. And if history serves us well, it usually doesn't end up exactly planned.
It won't be that smooth. It won't be that smooth.
That's the plan, but so it actually, when they really said, not only did they raise it to 75 basis points, which was expected, but also during the press conference, the commitment to the data, as opposed to saying, okay, we're going to raise here, 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 and here. They're saying, okay, we did this, and now we're going to depend on data to make our next moves. But the commitment to fight inflation is there, which is helping mortgage rates actually go down. Because if inflation goes down, rates will go down on mortgages, long-term rates.
What is the best way for someone to contact you?
Best way, my.
I guess Tim is going to help me. Here we are.
Let's go.
Here we are. I think it's a little bit of a small print, but I think it's cbabcock@loandepot.com.
Yep, very simple email. That's my web address there. So if you go to that website, you can actually apply directly on the website, and all my contact information is there. Or you can Google me. I have a unique name, so if you can Google my name, about 10 lines come up with me. So that's helpful. Also, I'm easy to find. I can't hide.
You are indeed.
I'm very much on the radar.
Well, you're on my radar, and I greatly appreciate you taking the time to share your knowledge. You're a good man.
Oh, thank you.
You've been a good friend to me, and you've been a good resource for my agents. Mm-hmm. I thank you. My agents thank you, and my house payment thanks you.
Well, thank you. I really appreciate the opportunity to come out and obviously offer your business and your friendship. Thank you.
Likewise. All right, take it away, Timothy.